Friends, welcome back to our channel Om Sai Bhojanapalli.
Of all, till now, let us consolidate and then go further. First of all, beta represents what? Everybody. Beta represents what? Rest. What rest? So when the market is dull, my sales also will be what? Dull. So every company gets affected through market. How much it gets affected is called as what? Beta. The magnitude of market change and the company change depends on three factors. When market changes by 1%, how much the company return what? Changes depends on three factors. Number one, the nature of the company product and services, yes or no? Second is what? The cost structure. How loaded is it with fixed cost. The third is what? Capital structure. All the three will be influencing the market change and the company return. Everybody following what I am saying? Now, in that case, the first two factors we call as what is business risk. Okay. So the beta that comes from businesses, we call as what beta? Asset beta. We call as what? Asset beta. The asset beta is same for levered company as well as what? Unlevered company. How you finance is not important. The business depends only on what? Product and the fixed cost structure. So in that case, the asset beta is going to be same for all equity company as well as what? Company which has borrowed. So asset beta is nothing but what? The source beta. Everybody following on? Now, this asset beta affects the beta of the security because in which business you are investing, that businesses come as your risk, yes or no? So the asset beta will be passed on to what? Securities which are having a stake in that asset, yes or no? One or two types of security is debt and then what? Equity. The debt security has got beta of 0 because the asset beta will not affect them since they are going to get a guaranteed return, yes or no? So the entire asset beta comes in the head of what? Shareholder, which we call as equity beta, right or not? This equity beta can be how many types here? Two types, namely one, unlevered, levered. If you are shareholder of an all equity company, a beta is called as what beta? Unlevered beta, which represents only what risk? Business is called as asset beta. You know, if you are shareholder of a levered company having a businesses as well as what? Financial risk to contend with. So there is a relationship between unlevered beta and levered beta. Tell me what is the relationship here? Beta unlevered is equal to beta levered into equity by debt plus equity. Beta levered is equal to beta unlevered into debt plus equity by equity. When you have taxation, beta levered is equal to beta unlevered into D into 1 minus T plus equity by equity. Beta unlevered is equal to vice versa. Respond, are you following or not? No. Why should we study this area called as levered beta, unlevered beta, etc.? Next question will arise or not? Okay, I'll tell you. The following situations where companies may be forced to use this concept for some practical purposes. Can I proceed or not? Now, first of all, understand that beta is very much required to calculate KE. Correct? KE represents risk or not? What is the formula for KE? R plus beta into R minus R. So beta very much required for what? KE. KE is nothing but a discount rate, right or not? No. Why KE is required? KE can be required for two purposes. Required for how many purposes? Yeah, two purposes. One is for share valuation. One is for what? Share valuation. Value of a share is the present value of the future cash flow. Discounted what? KE. The required rate of return is required for the valuation of the equity share. And second is for project selection. Second is for what? Project selection. Because I want to start a project. So for that project, I estimate the cash flows. Yes or no? Correct? No. Then the cash will be giving me what? IRR. Suppose the project is expected to give me an IRR of 16%. How much percent? 16%. Can I accept the project or reject that? It depends on my cost of capital. Yes or no? No. That is always how you accept a reject project here. Compare the IRR with what? Cost of capital. IRR more than cost of capital means the expected is more than what? Required return. I'll accept. Otherwise what? Reject. Ennappa right or not? No. Cost of capital means it is WACC, weighted average cost of capital, because for getting the money I may use debt as well as want equity. When I calculate WACC, I want KD and then what? KE. For KE require what? Beta. So for project selection also company requires what? Beta. There are two reasons why beta may be required for a company, or companies can use their betas. Are you following what I am saying? Now tell me, why should you have beta? Tell me. To have KE. Why should I require KE? For share valuation or for what? Project selection. The value of the share is the present value of the future benefit. Discount under what? KE. And for project selection, I have to calculate cost of capital. The word cost of capital means what? VAT. Weighted average cost of capital. It includes what? Cost of equity also. For that, the beta is required. Everybody following? Now, let me go to the next stage. See, I'll give you some examples. Number one. A company is going for IPO, and the company is going for what? IPO. First public issue the company is going, first time it is getting listed and going for what? IPO. Okay. Now, when the company is going for IPO, you should fix its issue price or not? Isn't it correct? No. Whatever I think, can I fix the issue price? Because SEBI will always ask justification for the price. Now, in today's world, we cannot price the issue how we require. The issue price, when you have to fix, the SEBI will be asking you what? Justification. We see all the, say, offer documents and all, we go for prospectus and all, they have to say, why are they going for the public issue, right or not? Sir, MTH went for what? Public issue. They raise some crores of money. For that they say, why they are wanting that money? You should be saying to what? SEBI. So I am going to raise this money for a Mangalore branch, or I want to build a new, what I say, complex. Something they have to say the reason for raising money or not. So the money why they are raising, they should give the reason to the SEBI, yes or no. And also they should justify the share price by valuing the share and showing to them. Are you following what I am saying? Now, when you value the share, you require a discount rate or not? For that you require KE or not? Now, this company will find difficult to find KE for itself. The reason is, beta it cannot find because till now it does not have a market price. Correct? Now, I cannot say past 5 years how the market has performed, how the company has performed. We cannot compare both because it's the first time entering into what? Market. I don't have data. Data is not available for me to calculate beta. Except if you go for scenario analysis, it's very subjective. Everybody follow what I am saying? In that case, the company requires beta. It cannot calculate the beta because sigma S by sigma M into correlation of S and M. I cannot correlate my company performance with what? Market, because the company and market, the prices are year-end price minus what? Year beginning price. Now, I don't have a price till now because the first time going for the IPO. Are you following what I am saying? In that case, the company has to have a beta or not? How to go for a beta? What the company will do is, company is doing similar business, listed on stock exchange, their beta they can take as their own beta. Are you following not? Any issue? Now, for example, MTH went for a public issue. Went for what? Public issue. They have to discuss a beta and PE ratio. I don't know. In that case, they don't have a beta because they are going for the first time in what? The stock market. What they can do? Other companies in the education sector doing what? Same business. Like an Educom or what? Carrier Point, etc. They can take what? Those companies beta and then what? Use that beta as what? Their own beta, which we call as proxy beta. Are you following what I am saying? Now, in that case, the business is same. The business is what? Same. I don't deny it. But that company will be having a different debt equity ratio and MTH will be having what? Different debt equity ratio. The beta cannot be taken as it is. Are you following? Then what I have to do? I have to convert that levered beta. That company beta is what? Levered with their debt equity ratio. Yes or no? I have to convert that levered beta into what? Unlevered beta and take only the business scale. Are you following what I am saying? So what I have to do? I have to convert that company's levered beta into what? Unlevered beta. The unlevered beta represents what? Asset beta or what? Businesses with the same as what? My company businesses. Take that unlevered beta and then reconvert it into what? Levered beta using my debt equity ratio. Yes or no? In that case, I should know how to convert unlevered into levered, levered into unlevered. This formula can be used. Point number one. Are you following? Is the first reason. Can I present? So, that beta is not available. Another company beta can be what? Used as my beta. In that case, they may have a different capital structure. I may have what? Different capital structure. I cannot take the beta as it is. I will take only what? Businesses. In that case, the levered should be made as unlevered. And then the unlevered can be reconverted into what? Levered. Using my debt equity ratio. This is a reason number one. I may be requiring what? The levered, unlevered beta discussion. Everybody following? Any issue? Now. Other area is, suppose a company is going for diversification. Going for what? Diversification. For example, MTH is now in education business or not. Suppose the company is there for past 10 years, track record is there. Okay. Now, this MTH from education business wants to go into pharma. They want to distribute medicine to students who are having headache in the class. It is not enough. For example, yeah? They want diversity into what? Pharma. Simple example. Now, they are not going to a related business. They don't want an unrelated business. For an unrelated project, they have to have a beta or not. The company cannot take their own beta because what they are present doing is what? A different business. Then they have to take only beta of that company is doing the pharma business. Are you following what I'm saying? In that case also, I may be forced to take another company beta. When you take that, you have to take only what? Unleavened beta. Only take the businesses, not what? Financialist. Are all the reasons why one may be forced to use leavened beta, unleavened beta concept. Based on this, some problems will be done in the next stage. Everybody following or not? So now tell me, can company use its own beta? Sometimes no. When it is no, when the company is going for the first time, the IPO, they may not have a data available to calculate what? Beta. Second case, they may go for a diversification. And Axis Bank, suppose, not allowed, yeah, or extreme thing, and Axis Bank goes into what? An entertainment sector. So no, all customers free tickets they may distribute and boost their sales. Goes to into what? Entertainment sector. In that case, they cannot take the banking sector beta because the sector is what? Different. For the new project evaluation, have to take only what? That sector beta. Respond. Are you following not? In such a case, I may be having a data available for an unrelated business. For related business, some other data should be taken. In all this case, takes only what? Businesses. Further, one should know how to convert lever to unlevered and unlevered to levered. Is the background introduction for this levered beta versus unlevered beta. Up to this, everybody having the clarity or not? We'll have a brief notes and then start with the problems in this regard. Write down notes. Can I switch on the AC? Yeah? Yes. Write down. Give the heading. Levered beta and unlevered beta. Please. Shh. Stop talking. Point number 1. Beta represents risk. Beta represents risk. That is, how much the company's return varies. Beta represents risk. That is, how much the company's return varies in relation to how much the company's return varies in relation to the variation in market. How much the company return varies in relation to the variation in market. In relation to the variation in market. Point number 1 or 2? 2. Risk can be classified into 2 types. Risk can be classified into 2 types. Branched into 2. Business risk, financial risk. Risk can be classified into 2 types. Branched into 2. Business risk and then financial risk. Business risk branched into 2. Business risk branched into 2. First branch, nature of product and services. Nature of product and services. Second branch is what? Cost structure. Nature of product and services and then cost structure. Second branch, put it down and write capital structure. Financial risk depends on what? Capital structure. Can I proceed? Point number 2 or 3? 3. Point number 3. When there is a recession in the market, point number 3, when there is a recession in the market, sales of companies gets affected. When there is a recession in the market, sales of companies get affected. How much it gets affected depends on depends on what? Nature of product or services. How much it gets affected depends on nature of product or services. Depends on nature of product or services. Continue. If the product is discretionary, the impact is more. If the product is discretionary, the impact is more. Discretionary means what? If you want, you buy it. If you don't like it, you need not buy it. There's no necessity for you to what? Buy it immediately. You can postpone the consumption is the meaning. If the product is discretionary, the impact is high and vice versa. The impact is high and vice versa. Next, point number 4. When the sales decreases, the operating profit, in bracket, what is the operating profit called? EBIT. When the sales decreases, the operating profit, in bracket write what? EBIT. The operating profit, bracket write EBIT, also decreases. How much percentage it decrease depends on how much percentage it decrease depends on what? Use of fixed cost in the cost structure. Depends on use of fixed cost in the cost structure. Use of fixed cost in the cost structure. More fixed costs are used, full stop and right, more fixed costs are used, more the risk. More fixed costs are used, more the risk. Point number 3 or 4 or 5. When the operating profit drops, obviously, when the operating profit drops, obviously, what drops? Return to shareholder also decreases. When operating profit drops, obviously, return to shareholder also decreases. But how much percentage it decrease? Depends on how much percentage it decrease depends on the debt proportion in. How much percentage it decrease depends on the debt proportion in. Depends on debt proportion in what? Capital structure. Depends on debt proportion in capital structure. Depends on debt proportion in capital structure. Everybody, are you following what I am saying? Can I proceed further? Next. Point number 2 or 3 or 4 or 5 or 6 or 6. Okay, point number 6. Okay. Write beta. Branch it into 2. Asset and securities. Beta, branch it into 2. Asset and then securities. Asset, put a down, I can write beta asset. We call as BA. That means what? Asset beta. Beta asset. Bracket la source beta. This only transfers the rest of the securities now. Asset beta. Bracket write what? Source beta. Very simple. If I invest money in company having high businesses, my equity risk will also be what? High. If I invest money in the company is having no businesses, my equity risk becomes what? 0. It all depends on the source beta. Asset beta also called as source beta. Now, security, bracket right, destination. Security, bracket right, destination. Branch it into 2, debt, equity. Branch it into 2, debt and then equity. right? Beta of debt is equal to 0. Beta of debt is equal to 0. Debt put it down, I can write beta D is equal to 0. Equity, right? Beta equity. Beta E, right? Beta E, branch it into 2. What are two types of equity beta? Beta L, beta U. Beta L, beta U. U or UL both are what? Same. Beta levered, beta unlevered. Beta L and then beta U. Can I proceed or not? Next. Point number 7. Point number 7. The business risk. The business risk is nothing but variability in company's profit. The business risk is nothing but variability in company's profit. The business risk is nothing but variability in company's profit. Full stop. Since the profit is shared by the securities, debt and equity, by way of interest and dividends, since the profit is shared by debt and equity by way of interest and dividends, the variability in profit also, now profit is variability of returns or not? Since they share the profit, the variability in profit also will be attributable to, the variability in profit also will be attributable to the securities. The variability in profit also will be attributable to the securities. The variability in profit also will be attributable to the securities. Up to this, are you following or not? Next. Point number 7 or 8 done? However, the debt security earns a constant interest. However, the debt security earns a constant interest irrespective of the business risk. However, the debt security earns a constant interest irrespective of the business risk. The debt security earns a constant interest irrespective of the business risk. Hence, debt beta is, and debt beta is what? 0. Then debt beta is 0. Thus, the entire asset beta now, hence the entire asset beta now is to be taken by, hence the entire asset beta now is to be taken by which security? Equity shares. Hence the entire asset beta now is to be taken by equity shares. That what they take is only asset beta. The source beta is what? Asset beta. Instead of 2 sharing, I am giving everything to what? 1 person called as what? Equity share. The asset beta is now taken by equity shares. Can I proceed or not? Next. Point number 5. Point number 9. Either one number, yeah? Point number 9. Okay, don't dispute it. Point number 9. Okay. Point number 9. If an equity shareholder is holding shares in an all equity company, if an equity shareholder is holding shares in an all equity company, if an equity shareholder is holding shares in an all equity company, his risk is only, fill in the blanks, his risk is only what? Business risk. His risk is only business risk. His risk is only business risk. And his beta is called, unlevered beta. And his beta is called unlevered beta. and this beta is called unlevered beta. Beta unlevered is equal to, continue, beta unlevered is equal to beta asset. Asset beta is equal to unlevered beta. Accept or not? Beta unlevered is equal to beta asset. Now asset beta represents business risk. His risk is only one, business risk. Beta unlevered is equal to beta asset. Up to this, everybody have the clarity or not? Next. Point number 10. If he is a shareholder in, if he is a shareholder in a company which has borrowed, if he is a shareholder in a company which has borrowed, if he is a shareholder in a company which has borrowed, then he has business and, then he has business and what? Financial risk. Then he has business and financial risk. Then he has business and financial risk. His beta is called, full stop, his beta is called what beta? Levered beta. His beta is called levered beta. His beta is called levered beta. Everybody understanding it or not? Point number 10 or 11? 11. Obviously, beta L greater than beta U. Accepted? Obviously, beta L greater than beta U. Their relationship can be understood as follows. Obviously, beta L greater than beta U, and their relationship can be understood as follows. And the relationship can be understood as follows. Branch it into two. No tax, tax given. Branch it into two. No tax and then tax given. Can you stand or not? No. No tax. Tell me the formula. Put it on the right formula. Beta L is equal to, no tax, right? Beta L is equal to what? Beta U into debt plus equity divided by equity. Beta L is equal to beta U into debt plus equity by equity. Then rearrange and understand now what is beta U is equal to what? Beta L into equity plus debt plus equity. That you can write or not? Now leave it. Next, with tax. Put it on, I can write. Tell me the formula. Beta L is equal to what? D into 1 minus T plus equity. Beta U into D into 1 minus T plus equity divided by equity. You understand it or not? Beta U into same D into 1 minus T plus equity divided by equity. D into 1 minus T plus equity divided by equity. This is a relationship between the levered beta and unlevered beta. Can I proceed or not? No. Point number 11 or 12? 12. Point number 12. Why should we know the concept of levered and unlevered beta? Why should we know the concept of levered and unlevered beta? Why should we know the concept of levered and unlevered beta? Can I proceed? Right, A, point A. Beta is required to calculate. Beta is required to calculate KE. Point A. Beta is required to calculate KE. Point B. KE is required for two main purposes. KE is required for two main purposes. KE is required for two main purposes. Branch it into two. What are two main purposes? First branch is what? Share valuation. Second branch is project selection. Share valuation and then project selection. Share valuation, put a down arrow mark and write. Put a down arrow mark and write. KE used as discount rate. Share valuation, right? KE used as discount rate. Yeah, correct. I need to explain for them what is the value of a share. Tell me. Present value of the future benefits. KE is used as discount rate. Project selection, right? IRR compared with WACC. IRR compared with WACC. WACC means what? Weighted average cost of capital. IRR compared with WACC. And to calculate WACC, KE required. IRR is compared with WACC. And to calculate WACC, for calculating weighted average cost of capital required KD and KE, yes or no? To calculate WACC, KE is required. To calculate WACC, KE is required. Everybody able to understand this or not? Now, point B or point C or point C? Point C. Company sometimes cannot use, point C, company cannot sometimes use its beta. Company sometimes cannot use its beta to calculate its KE. Company sometimes cannot use its beta for calculating its KE. For example, Axis Bank may not be able to use its own beta if it goes for an unrelated business, yes or no? So, company sometimes cannot use its beta to calculate its KE in the following two cases. In the following two cases. Branch it into two. First branch goes for the issue first time. Goes for public issue first time. Goes for public issue first time. Second branch is what? Diversify into unrelated business. Diversifies into unrelated business. Goes for public issue for first time. Second branch is what? Diversifies into unrelated business. First branch would have again, right? Data not available. Data not available to calculate beta. Data not available to calculate beta. Do you understand that? Past 5 years, how the company perform, how the market perform, no relationship because first time entering the market, yes or no? Data not available to calculate beta. Second branch, right? Company's beta is unrelated to. Company's beta is unrelated to the risk of the new project. Company's beta is unrelated to the risk of the new project. Company's beta is unrelated to the risk of the new project. Did you understand what I am saying or not? Now, I am going for a pharma sector, but I am now in iron and steel means my beta cannot become what? The beta of the non-new project. Yes or no? Last point. B or C? Point D. In such case, it should take the beta of another company. In such case, it should take the beta of another company having the related business. In such case, it should take the beta of another company having the related business. It should take the beta of another company having the related business, which is called what beta? Proxy beta. Which is called proxy beta. Which is called proxy beta. Continue. But we cannot take the beta as it is. But we cannot take the beta as it is. We cannot take the beta as it is because the capital structures may differ. But we cannot take the beta as it is because the capital structures may differ. Because the capital structures may differ. The capital structures may differ. In that case, we require the beta to be converted into. We require the beta to be converted into. Please, if you all awake and writing, convert into what? Unlevered beta. We require the beta to be converted into unlevered beta. That represents only what risk? Business risk. we require beta to be converted into unlevered beta that represents business risk. That represents business risk. And reconvert into levered beta and reconvert into levered beta and reconvert into levered beta using using what? This company's capital structure, and reconvert into levered beta using this company's capital structure. With this we complete. Everybody able to understand the background or not? Now we'll start doing the problems in this regard. Please take the questions. Okay, please. Let's take. No break, please. Can we start now? Now. Take question number 34. In between all the sums will be completed. Let's start with question number 34. Let's be fast. We should complete 34, 35 and if possible 36 in today's class. Can you start or not? No. Very good. Take 34. Question number 34. Please. Two companies identical in all respects except capital structure. One company, AB Limited, has a debt equity ratio of 1:4. Stop talking. And its equity has a beta value of 1.1. Wrongly typed. Beta value of 1.1. Again I repeat. Two companies are identical in all respects except capital structure. One company, AB Limited, has a debt equity ratio of 1:4 and its equity has a beta of 1.1. Made a change or not? The other company, XY Limited, has a debt equity ratio of 3:4. Income tax rate is 30%. Estimate beta value of XY Limited given the above. Please, can we start or not? No. Okay. Let us see how we should answer and then go for the solution. Two companies, name the two companies, AB Limited, XY Limited. Both companies are different, almost same, almost same. Only difference is what? Capital structure. That means the asset beta of both the companies should be same, yes or no? Or you can say the unlevered beta of both the companies should be same, yes or no? The unlevered beta represents what? Asset beta. Okay, the unlevered beta should be same for what? ABC and AB and then what? XY. Now, can I say AB Limited beta is 1.1. AB Limited beta is what? 1.1. XY Limited beta also should be 1.1. True or false? Why it is false? We are having a different capital structure. Even though businesses may be same, the financial risk is what? Different. Without calculating, no need for number. Tell me, XY Limited beta will be less than 1.1, more than 1.1. Answer. AB Limited beta 1.1 or not. XY Limited risk will be more than 1.1 or less than 1.1. Why more than 1.1? There is having more debt proportion in the capital structure. Respond yes or no. Now, they ask you to calculate what is the beta of what? XY limiter. Respond yes or no. Tell me what I should do. First, 1.1 AB limited beta should be converted into what? Unlevered beta. That unlevered beta becomes the beta of what? XY limiter. That you convert into what? Levered beta. When I unlever it, I should use what debt ratio? 1:4. When I relever it, I should use what debt ratio? 3:4. That's the answer for this particular sum. Inna right or not? Further, we use the unlevered beta, levered beta formula. Now, once again, a past examination question. Can I start doing the solution or not? Now, write down first. We'll do it together, please. We'll do it together. Question number 34. Step 1. Calculation of beta u of AB limited. Calculation of unlevered beta of AB limited. I hope you are understanding, reading or not. Calculation of unlevered beta of AB limited. D is to E. Debt equity ratio. Debt is to equity. D is to E. What is D is to E? 1:4. Debt is to equity is 1:4. Can I proceed? Now, formula. We have to calculate unlevered beta, no? Tell me the formula. What is the formula? Beta u is equal to what? Next, beta L into E by D into 1 minus T plus E. Beta u is equal to beta L into E by D into 1 minus T plus E. Beta levered into E by D into 1 minus T divided by D into 1 minus T plus E. Tell me the number substitution. What is the levered beta of this particular AB limit? How much it is? It is 1.1 into 1.2. Romba simple. What is equity? 4. 4 divided by what? 1 into 1 minus 0.3. D is 1. 1 into tax rate is what? 1 minus 0.3. 1 into 1 minus 0.3 plus what? 4. 1.1 into 4 divided by 1 into 1 minus 0.3 plus 4. I want an answer. Those understanding the substitution and calculation, raise your hand. Everybody, I think you are all following or not? Now, so tell me, what is the number here? How many times? 0.94 times. 0.94 times. 0.94 times. Now, my question is, why unlevered is 0.94, levered is 1.1? This represents only businesses. That represents what? Business and financial industry. My question is, AB and XY are doing different business or same business or same business. That means if AB unlevered beta is 0.94, XY also be what? 0.94. You got assumption that the cost structure is what? Same. Because we cannot do for that. We have to assume the constant is going to be what? Same only. In that case, the unlevered beta of XY also is what? Same 9.94. Then we have to relever it or not. Right now, next step 2. Calculation of beta levered of XY limited. Calculation of beta levered of XY limited. Calculation of beta lever of XY limited. Can I start or not? Now. Write the debt equity ratio. Debt is to equity. Everybody, D is to E is equal to what? 3:4. D is to E is equal to 3:4. Formula. Please tell me the formula. Beta L is equal to, all of you tell and write. Beta L is equal to what? Beta U into D into 1 minus T plus E divided by E. Beta L is equal to beta U into D into 1 minus T plus E divided by E. D into 1 minus T plus E divided by E, which is equal to, what is the unlevered beta? We calculated the previous step here. Point. Is the unlevered beta of AB, how can take for XY? Both are having what? Same businesses. And we take what? 0.94. Beta L is equal to 0.94 into, tell me what into what plus what? 3 into 1 minus 0.3 plus 4. 3 into 1 minus 0.3 plus 4 divided by what? 4. Divided by equity is what? 4. Divided by 4. Guess how much it is going to be? 1.43 times. It is 1.43 times. 1.43 times. I have a doubt. Both companies are doing the same business. Everything is same. Why XY is having more beta? Because its debt proportion increases. So the risk also increases. The 1.43 is what risk? Systematic risk only, because it is a change in the profit due to what? The market change. Everybody are you saying? The systematic risk is magnified using what? A leverage. That is what we call capital market line extended discussion. Not is magnified using what? Leverages. But previously persons what? Businesses. The change in profit due to the macroeconomic factors. Everybody following or not? Now, with this we complete solution to question number 34. Can you move to question number 35 or not? Now, take question number 35. Stop talking. Take question number 35. Vinay Company's weighted average cost of capital. Don't turn the page, the same page only question is sir. It or not? What noise here? Pen, page turning, talking. What is happening? Okay, now. No need for notes. Already given 12 points or not. In the only point is there for this also. Can I see? Now, next. Vinay Company. I know why you are all asking notes to just avoid one or two sums later. Can I see? No, that no notes in this Samya, because already discussed the same businesses, only what? Final risk changes, so there's going to be a different debt equity ratio, different risk. Can I say? Now, Vinay Company's WACC is 10%, its tax rate is 35%, Vinay Company's pre-tax cost of debt 10%, its debt equity ratio 1:1, risk-free rate is 8%. Market risk premium. What is market risk premium? RM minus RF. RM minus RF is 7%. What is the beta of the Vinay Company's equity is the question. Can I answer or not? Now, we have to do the reverse working from WACC. We have to calculate KE. From KE, we should calculate what? Beta. Can I start or not? Now, write down first. We'll do it together. Question number 35. Step 1. Calculation of KE. Calculation of KE. Source, proportion, cost, weighted cost. Source, proportion, cost, and then weighted cost. What are the two sources? Tell me. Equity, debt. Source is equity and then debt. What proportion? 1:1. That means what? 0.5, 0.5. Proportion is 0.5, 0.5. Is cost of equity given or not given? Not given. We have to find out. Cost of debt given? Yes. The debt is how much percent? 10%. Always cost of debt is having a tax shield or not? Yes. 10% into 1 minus T. What is the cost of debt here? 10 into 1 minus 0.35. Right, 10 into 1 minus 0.35. Is it how much percent? 6.5. The cost of debt is 6.5. Okay. Weighted cost I cannot find for equity. Leave it. What is the debt here? 0.5 into 6.5. And then what is the weighted cost of debt? Tell me how going to be? 3.25. The weighted cost is 3.25. Weighted cost 3.25. The WACC is what overall cost of capital? 10. The WACC is 10. Given in the question now, first the WACC of the company is 10%. In this 10, 3.25 is the weighted cost of what? Debt. What is the weighted cost of equity? 6.75. Weighted cost of equity is 6.75. 0.5 into something gives you 6.75. So no. What is the something? 6.75 divided by 0.5. How much going to be? 13.5. The cost of equity is 13.5. 6.75 divided by 0.5. 13.5. The cost of equity is 13.5. K is equal to how much percent? 13.5. Enough for it or not? Now. I now know KE. I have to calculate beta or not. Write down step 2. What is step 2? Calculation of beta lever. Why levered beta? This is a shareholder of a company which is having borrowings or not. So the beta always should be what? Levered beta here. So no. Calculation of levered beta. Calculation of levered beta. Shall I proceed? Now, what is the formula for KE? I forgot. What is the formula for KE? RF plus beta into RM minus RF. K is equal to RF plus beta into RM minus RF. RF plus beta into RM minus RF. Now, do you know risk-free rate or not? Yes. Now, here, before I proceed, I want to have a small discussion and then proceed. Debt is also risk-free. And there is also what? Another risk-free rate. Okay. Generally, there are so many types of debt which is available in the market. In that case, when varieties of debt are available in the market, the word risk-free rate is only going to be attributed to the highly rated bond. Attributed to what? A highly rated bond. In any given country, its government bond will be highly rated. Yes or no? Government of India bond is better than a bond of a Sundram Finance. Are you understand what I am saying? In that case, highly rated bond only will be what? Taken as the risk-free rate. If they don't give you risk-free rate, then the debt percentage itself can be taken as what? Risk-free rate. Debt is also risk-free. Beta is equal to what? 0. So now, risk-free rate may be given in the question, may not be given. If they give in the question a risk-free rate, that should be taken. If the question is silent about what? Risk-free rate, then you can just take what? The debt cost as what? The risk-free rate, because debt beta is 0. It is also can be assumed to be what? A risk-free asset. Right or not? Now, correctly the risk-free rate should be given. Otherwise, you can take the cost of debt. Can I proceed or not? Now, another thing is, the government of India bond is giving how much percent return? 8%. Now, what is a return which this company's debt is going to give you? 10%. Why it is more than 8%? The reason is it is having more risk. Not the risk of the profit, not the risk of what? Profit, but the risk of the person who is borrowing. Yes or no? Because always borrower risk also is what? One source of risk which we ignore in this beta calculations. Everybody following up? Now, tell me what is the number? KE is equal to, what is KE? 13.5 is equal to 8 plus. RF is what? 8. 13.5 is equal to 8 plus beta into 7. 13.5 is equal to 8 plus beta into 7. Rearrange. I get 7 beta is equal to 13.5 minus 8 is equal to 5.5. 7 beta is equal to 5.5. Beta is equal to what? 5.5 by 7 is equal to 0.79 times. Beta is equal to 0.79 times. This is what beta? Levered beta. Let us also calculate unlevered beta. Step 3 is what? Unlevered beta. It is also called as what? Asset beta. Unlevered beta or asset beta. Unlevered beta or asset beta. Debt is to equity 1 is to 1. Debt is to equity 1 is to 1. Formula beta unlevered, beta asset is equal to, you can also call as beta unlevered is equal to, beta asset is equal to formula beta levered into equity by D into 1 minus T plus equity. Beta levered into equity by D into 1 minus T plus equity. Substitute the numbers. What is levered beta? We are having a beta asset is equal to 0.7 into 0.7 into substitution 1 by 1 into 1 minus 0.35, 1 by 1 into 1 minus 0.35 plus 1. 1 by 1 into 1 minus 0.35 plus 1 is equal to how much here? 0.48 is equal to 0.48. Write down the business risk of this Vinay company has a beta of, the business risk of the Vinay company has a beta of how many times? 0.48 times. the businesses of Vinay company has a beta of 0.48 times. Since the company has borrowed, the shareholder in addition to business risk, since the company has borrowed, the shareholder in addition to business risk will also have the shareholder in addition to business risk will also have what? Financial risk. The shareholder in addition to business risk will also have financial risk. Hence, the equity beta is how many times? 0.79 times. The equity beta is 0.79 times. Up to this question number 35, everybody are you following or not? Now, take question number 36. Please. Stop talking. Mark it as a very important question. All aspects of levered, unlevered beta, proxy beta will be covered through this particular sum. It was a very old RTP sum, but a very good problem we are going to do. Mark it as important. Please. Shh. Stop talking. Excellent Limited is a frozen food packaging company and is looking to diversify its activities into electronics business. The project it is considering as a return of 18%, and Excellent Limited is trying to decide whether the project should be accepted or not. Now, I don't want to read the full question, explain one by one. It will take time. Okay, up to this, what is understandable is, this company, Excellent Limited, is doing what business at present? Frozen food packaging business. They want to start a new project in their same business, unrelated business, unrelated. They want to start a new project. Which business? Electronic business. That project is expected to give how much return? 18%. This 18% is called as what? IRR of the new project. Yes or no? No. Tell me, is this 18% sufficient or not sufficient? Sufficient, not sufficient? It depends on your cost of capital. Yes or no? That is, if I invest, I'll be earning how much? 18%. The return on investment is 18%, but it is sufficient. The cost of capital should be what? Less than 18%. I don't know now. To accept the project or not, I not only require IRR, I also require what? Cost of capital. Cost of capital means cost of debt, cost of equity, WACC. So I have to calculate the WACC for this particular project. To calculate WACC, I require what? KE. To calculate, I require what? Beta. Can I use a beta of this company itself? No. No, because it is doing what business? Frozen food packaging. It wants going to want electronic. So I should take the electronic business beta as a proxy beta to calculate its KE and its WACC. This is the substance of the problem. Yes or no? No. For this, he collected more data. See. To help it decide, it is going to use CAPM, Capital Asset Pricing Model. The company has to find a proxy beta for the project and has the following information on 3 companies in the electronics business, namely Superior Limited, Admirable Limited and Meritorious Limited. Superior Limited, equity beta 1.33, financed by 50% debt, 50% equity. Admirable Limited has an equity beta of 1.3, but has just taken up a totally unrelated project accounting for 20% of the company's value. That has an asset beta of 1.4. The company is financed by 40% debt, 60% equity. Meritorious Limited, equity beta is 1.04, financed by 35% debt, and 65% equity. Assume all the debt are risk free and the corporate tax, not corporation tax, the corporate tax at a rate of 35%. Once it becomes 3.5, I became very happy. It becomes how much percent? 35%. Excellent Limited is financed by 30% debt, 70% equity. The return on risk-free security stands at 10%. The return on the market portfolio is 14%. Should the company accept the project is the question. Can we start or not? No. See, broadly we'll discuss what we are going to do and then go for the numbers. Can we start or not? Now, see. Already we said that this new product is expected to give an IRR of 18%. But it should be compared with cost of capital. For that I have to calculate WACC. KD given in the question. But I have to find out what? KE. To know the KE, I should declare what? Beta. Beta of frozen business or beta of electronic business? Electronic business. Am I doing electronic business? No. I should only take the beta of what? Those doing the electronic business. Respond yes or no? No. That means I am going to take the proxy beta. I am going to take what? Proxy beta. Now, when you take a proxy beta, you should take the following things. You should be careful about the following things. Take only their business risk and don't take their financial risk. Now the other company debt equity ratio and my company debt equity ratio may be what? Different. So when you take the beta, only take the unlevered beta, don't take what? Levered beta as it is. So take only what? Business risk and don't take what? Financial risk is rule number 1. Yes or no? No. Don't take the businesses also as it is. There also one should be careful. If the other company is doing more than one business, now, then its share return volatility depends on the electronic business alone or more than one business, more than one business. In that case, that beta becomes a portfolio beta for the company. It is having a portfolio of electronic business, unrelated business. So that company beta actually is what? A portfolio of multiple project beta. Yes or no? In that case, I should take only what? Electronic business beta and leave out what? Unrelated business beta. So when I take the beta of another company, I take a beta of what? Another company, I should be very careful. I should take only related business beta. I should not take what? Unrelated business beta. Number 1, yes or no? That way I should take only what? Business beta. I should ignore what? Financial risk is a rule one should have while calculating the proxy beta. And that too, don't rely on a beta of a single company in that sector. Take more than one company to average out extremes. To average out what? Extremes. So if I take 3 or 4 companies and take an average, it becomes more representative of what? The businesses rather than relying only on what? One company's beta. Now, all this because one company may be having more fixed costs and may be having what? Less fixed costs and so on. To even out those small discrepancies, one can take what? 3 or 4 companies beta, average out and take it as a proxy beta. Everybody following up? Now, in this process, you identify how many companies? 3 companies. Name the 3 companies. Superior Limited, Admirable Limited, Meritorious Limited. Superior Limited is having what debt equity ratio? 50% debt, 50% equity. My project is going to have how much debt equity ratio? 30-70. Are their financial risk and my financial same or different? Different. So can I take 1.33 as it is? No. What should do? Unlever it to consider the proxy beta. Yes or no? No. Come to meritorious. What meritorious beta? 1.05. Can I take 1.05 as it is? No. It is what beta? Lever. Unlever it. Take it for proxy. Yes or no? And for admirable, I have to do 2 things here. One is what? Unlever it. And also 20% is what? Unrelated business. That also should be weeded out and take only the unlevered related business beta. These are the 3 things I have to take. Take all the 3 betas, add and divide by 3 to get the average proxy beta. Then calculate KE and then calculate WACC. Compare with what? 18%. Say a project should be accepted or rejected. A capital budgeting problem. Are you following? Using what? A CAPM approach. Now, understand that in real world, for making project decisions, people are using what? CAPM. Because KE, they don't find it on an ad hoc basis. They do what? Equity research, identify what? Beta, and scientifically calculate KE for the purpose of selecting or rejecting a project. Everybody, can I proceed or not? Now, let's start doing the solution one by one. Now, My first aim is to find out the proxy beta from what? Superior limited, admirable limited, meritorious limited. By converting all the levered beta into what? Unlevered beta. For admirable also two work is there. Also what? Take only the related business beta. Can I start that or not? Let's do it together. We have only limited time. Let's do fast. Okay. See, my difficulty is I cannot continue the sum in next class, yeah, because Tuesday also holiday. We'll come back only on Thursday. Right, yeah, right or not? Please. I already announced in previous class. I announced it. So today let us complete this problem. I'll leave you, please. Can I proceed? No, don't. Wait. I'll announce everything. Don't waste time now. See, very simple, yeah. 1 minute, don't talk. Tomorrow I plan to have AMA class, costing class, class. Okay. Tomorrow no class. Tuesday for Shankranti, leave is what given. So now next class only is on what? Thursday. No, long gap, yeah. Okay, that is why I have to complete the sum. Don't talk. I am tensed. Let us start. Okay, can you start right now? First, step 1. Calculation of, start writing, step 1. Calculation of unlevered beta of related business. Calculation of unlevered beta of related business. Calculation of unlevered beta of related business. Okay. We're going to take one proxy or three proxies or three proxies. And then right, first step A, calculation of beta u of superior limited. Now routine calculations, do with me fast. Calculation of beta u of superior limited. Calculation of beta u of superior limited. Okay. Look at the workbook and tell me what is the debt equity ratio? 50%, 50%. It is 1:1. Debt is to equity is 1:1. Okay. Formula beta unlevered. We have to calculate or not? Is equal to beta unlevered is equal to formula is what? Beta levered into E by D into 1 minus T plus E. Beta unlevered is equal to beta levered into E by D into 1 minus T plus E. Substitute the numbers. What is the beta of superior limited? 1.33 into beta unlevered is equal to 1.33 into E by, what is E by? 1 by 1 minus, what is tax rate? 30 or 35? 35%. 1 by 1 minus 0.35 plus 1. 1 by 1 minus 0.35 plus 1. 0.35 plus 1 is equal to how many times here? 0.81 times. Beta always expressed in times is equal to 0.81 times. This 0.81 time represents what risk? Electronic business risk. Yes or no? Now, we have weeded out the financial risk part by making it as an unlevered. Can I proceed or not? Now, everybody, those who understood, raising hand here up to this. Can I proceed? Now, step B. I'll do for meritorious and then come to admirable. Okay, next step B, calculation of beta unlevered of meritorious limited. 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 Okay, now first write the debt equity ratio. Question all debt equity ratio. What is to what? It is 35% debt, 65% equity. Simply write as it is. D is to T is equal to 0.35 is to 0.65. Now debt is 35%, 0.35. Equity is what? 65%, 0.65. D is to T is equal to 0.35 into 0.65. Can I proceed? Formula. Beta U is equal to beta L into E by beta U is equal to beta L into E by D into 1 minus T plus E. beta L into E by D into 1 minus T plus E. D into 1 minus T plus E. Substitute the numbers. What is the levered beta of this meritorious limit? Everybody answer here. 1.05. Why is not coming? What is the answer? 1.05 into 1.05 into. Please tell me the substitution. What? 0.65 divided by 0.65 divided by what? 0.35 into 1 minus 0.35 plus 0.65. 0.65 divided by 0.35 into 1 minus 0.35 plus 0.65. Right or not? Yes or no? How many times here? 0.78 times. 0.78 times. 0.78 times. Okay. Now, step C is what? Admirable limited. Calculation of beta U of admirable limited. I hope you all finished copying in our previous line. Okay. Step C. Calculation of beta U of admirable limited. Calculation of beta U of admirable limited. Okay. Beta U, it's a debt equity ratio is equal to, debt is to equity is equal to, what is a proportion of debt? 40%. Equity is what? 60. How to write? 0.4 is to 0.6. Debt is to equity is equal to 0.4 is to 0.6. Beta U is equal to, unlevered beta is equal to levered beta into E by D into 1 minus T plus E. Unlevered beta is equal to levered beta into E by D into 1 minus T plus E, which is equal to, what is levered beta of this company? Look at the question. What is the beta of this company? The beta of the company is 1.3. 1.3 into 1.3 into what is equity? 0.6 divided by 0.6 divided by 0.4 into 1 minus the 0.35. 0.4 into 1 minus 0.35 plus 0.6. 0.4 into 1 minus 0.35 plus 0.6. What's the number here? 0.91 times. 0.91 times. Now, stop writing and tell me, can I take this 0.91 time as a beta? No. This is a project beta, portfolio beta. This is a, understand that company itself is a portfolio. Any company is a portfolio. Is a portfolio consisting of what? More than one asset or more than one business. Very simple. Yeah. See, suppose I invest in a company. I invest in Infosys. I invest in what? Another company, Axis Bank. That means, as an individual, I am investing in a banking business. I am investing in an IT business. Right or not? Now, instead of doing so, this is a portfolio investment or not? What is my beta? Portfolio beta. Now, see, Rajagopal is buying share of what? Infosys and buying what? Axis Bank share. Example. That's what I am saying. In that case, now, I am investing in what? How many business? Two business. One is what? A banking. Another is what? An IT related. Yes or no? Now, instead of doing this, I can buy a share in a company which is doing both the business. Yes or no? Because the company is what? A portfolio. It is what? Portfolio. A company is nothing but portfolio project. The portfolio project is what? The company's beta. That is always a portfolio beta. Right or not? Now, so this company, Admirable Limited, is doing a single business, multiple business. So its beta of 0.91. Businesses is a individual business, portfolio business. We all know what is portfolio beta, weighted beta of the individual businesses. Yes or no? What I am saying? So can I proceed further? Now, we know the portfolio beta of this company how much times here? 0.91 times. Can I proceed? In that, I want to know inside this 0.9, what is the beta of my related electronic business? Right or not? Now, next step. Step C or step D? Step D. Calculation of, step D, calculation of unlevered beta of, calculation of unlevered beta of Admirable Limited's related business. Calculation of unlevered beta of Admirable Limited's related business. Calculation of unlevered beta of Admirable Limited's related business. Related business. Can you put the numbers or not? Tell me what is the formula for, what is the columns for calculating portfolio beta? The business, which we call a source, I call as what? Business. Next is what? Proportion, beta, weighted beta. Normally we write securities na, instead of security write what? Business. Business, proportion, beta, weighted beta. Tell me, what are the two businesses? Related, unrelated. Related, unrelated. If I have 100 rupees capital, entire 100 put in related, unrelated, what ratio? 80-20. Because 20% of the money is in what? Unrelated. 0.8, 0.2. Proportion is 0.8 and 0.2. Now see, they are also given. It has just taken on a totally unrelated project. Able to relate or not? Accounting for 20% of the company's value, that has an asset beta, how much here? 1.4. So the word asset beta means what? Unlevered. So what they can straight away is what? Unlevered. You need not unlever it. Yes or no? So what is the beta? 1.4. The beta is 1.4. The beta is 1.4. 0.2 into 1.4 gives you what? 0.28. The weighted beta is 0.28. We know the portfolio beta is what? 0.91. Last step, portfolio beta is 0.91. That means what should be the weighted beta of related business here? 0.63. 0.63. 0.8 into something gives 0.63. What is the something here? It is 0.8 divided by 0.60 divided by 0.8. Is equal to how much here? 0.79. Is equal to 0.79. Is equal to 0.79. Respond, yes or no? Now, very simple, understand this. Admirable Limited has invested 80% money in a related business having a beta of 0.79 and 20% money in what? Unrelated business having a beta of 1.4. So its portfolio beta becomes what? 0.91. This we call as asset beta, where I have a portfolio of asset. Yes or no? Now, this asset beta is not the beta of admirable because the admirable is having what? Debt equity mix, which I will leverage. It is having a beta of how many times here? 1.4 times, 1.05, 1.3 times. Everybody following or not? Now, next, step 2 or step 3? Step 2, proxy beta. Step 2, proxy beta. Step 2, proxy beta. Can you start or not? Now, formula. Proxy beta is equal to average beta. Can I take superior as a representative, admirable, meritorious, all the three? All the three. Take the average, weeds out extremes. Okay, proxy beta is equal to average beta. I cannot rely on one company's beta. It may be sometimes have some extremes also. Okay, proxy beta is equal to, tell me what plus what plus what by 3 it is? 0.81 plus 0.78 plus 0.79 divided by 3. 0.81 plus 0.78 plus 0.79 divided by 3 is equal to how many times? 0.79 times. Is equal to 0.79 times. Okay. Now, what is 0.79 times? Tell me. Don't say proxy beta, it is already known. Never 0.79 time. It represents the electronic businesses. Represent what? Electronic businesses. Yes or no? For my projects KE, can I take 0.79 times a beta or not? No. Because I am not only having electronic businesses, I am going to do my project by borrowing or not? Yes. That means this 0.79 times unlevered beta should be converted into what? Levered beta using the project's debt equity ratio. Respond yes or no? No. Next, step number 2 or 3? 3. Converting proxy beta to levered beta. Step 3. Converting proxy beta to levered beta. Converting proxy beta to levered beta. Are you understanding writing? Don't think about time. Are you following or not? Converting proxy beta to levered beta. Can I proceed now? Calculation of beta L of Excellent Limited. That is our company. Get up? Calculation of beta limited of beta levered of Excellent Limited. Calculation of beta levered of Excellent Limited. Look at the workbook and tell me what is a debt equity ratio of the new project. In the last paragraph, what is the debt equity ratio? 30 and 70. D is to E is equal to 0.3 is to 0.7. D is to E is equal to 0.3 is to 0.7. Beta L is equal to Formula beta L is equal to beta U into D into 1 minus T plus E by E. Beta L is equal to beta U into D into 1 minus T plus E divided by E. Substitute the numbers. What is unlevered beta, proxy beta? 0.79. 0.79 into 0.79 into 0.3 into 1 minus 0.35. 0.3 into 1 minus 0.35 plus 0.7 D into 1 minus T plus E whole divided by what? 0.7. Whole divided by 0.7. What is the beta? 1.01 times. Beta is 1.01 times. This is a beta I should take to calculate the KE for this project. Yes or no? 1.01 times. Can I proceed or not? Now, next. Step number what? 4. Calculation of KE. Routine number calculations. Calculations of KE. Calculation of KE. KE is equal to RF plus beta into RM minus RF. K is equal to RF plus beta into RM minus RF. K is equal to, look at the question, what is the risk rate given, how much it is? 10%. Is equal to 10% plus 1.01 into 10% plus 1.01 into 14 minus 10. 10% into 1.0. What is 14%? RM. Written on market portfolio given. Yes or no? So 10% plus 1.01 into 14 minus 10 is equal to how much? 14.04%. K is equal to 14.04%. Can I proceed or not? Next. Last step. Calculation of KO. Other name for KO is what? WAC. Weighted average cost of capital and overall cost of capital. Step 5. Calculation of KO. The last step. Don't worry. Calculation of KO. Step 5. Calculation of KO. Please. Can you start or not? No. Have the following columns. Source, proportion, cost, weighted cost. Source, proportion, cost and then weighted cost. I am getting the money from how many sources? 2 sources. Name the 2 sources here. Equity, debt. 2 sources, equity, debt. I am planning to raise in what proportion? 0.7.3. 0.7.3. Last step only we calculated KE. Please tell me what is KE here? 14.04. KE 14.04. KD is 10% into I into 1 minus T. Yes or no? Tax shield is in debt or not? It is 10 into 1 minus 0.35. 10 into 1 minus 0.35. 10 into 1 minus 0.35. Is equal to how much? 6.5. Right or not? 10 into 1 minus 0.35 gives you what? 6.5. Weighted cost. 0.7 into 14.04. What is weighted cost here? 9.83. 0.3 into 6.5. The weighted cost is 1.95. 9.83, 1.95. What is the total here? 11.78. WACC is 11.78%. WACC is 11.78%. Answer my question. The project gives you how much percent return? For this project risk, is 18% sufficient or not? Yes. The required return is only how much? 11.78. Write down. The IRR of the project is 18%. The IRR of the project is 18%, while the cost of capital is only 11.78%. The IRR of the project is 18%, while the cost of capital is only 11.78%. Thus, the project can be accepted. Thus, the project can be accepted since it will give positive NPV. The project can be accepted since it gives positive NPV. The project can be accepted since it gives positive NPV. Because when return on investment more than cost of capital, wealth increases. Yes or no? So it gives positive NPV. Okay. Now, We'll have the next class on Thursday. Okay.
థ్యాంక్ యూ ఫ్రెండ్స్. ఓం సాయి భోజనపల్లి.